The only 3 ETFs Warren Buffett would recommend to beginners. Let me tell you something that most financial advisors never tell beginners. They want to complicate things. They want to talk about sector rotation and factor investing and technical analysis and all these sophisticated concepts that make you feel like you need to hire them to manage your money. But here's the truth that I've learned. After investing for over 70 years, 99% of investors, including most professionals, would be better off if they simply bought 3 index funds and held them for decades. That's it. 3 funds, buy them, hold them, don't touch them, become wealthy. It's that simple. The challenge is that simplicity doesn't sell. Financial advisors don't make money if you just buy 3 index funds and hold them. Financial advisory businesses need complexity. They need to justify their fees. They need to convince you that you need their expertise, so they create complicated strategies and they talk about active management and stock picking and market timing, and most of them underperform a simple index fund approach by 1 to 2% per year over 30 years. That difference is absolutely massive. A 1% annual underperformance compounds into losing 40% or more of your potential wealth. That's not a rounding error. That's life-changing money. I want to do something different with you today. I want to tell you that if you're a beginner and you want to build long-term wealth through investing, you actually don't need to be complicated. You don't need to understand technical analysis. You don't need to follow the news. You don't need to time the market. You just need to commit to buying 3 specific ETFs and holding them for 20, 30, 40 years. That's the entire system. And if you do that with discipline, if you actually do it and don't second guess yourself, I guarantee you that you will build significant wealth. You might not get rich quick, but you will get rich. Now, let me be clear about what I mean by beginners. I'm talking about people who are just starting to invest, people who have a job, a salary, some money to invest each month or each year, and a desire to build wealth over time. I'm not talking about professional investors. I'm not talking about people with millions of dollars who need sophisticated strategies. I'm talking about regular people, people like you, probably people who want to invest but don't have time or interest in picking individual stocks. Here's my philosophy on this. The vast majority of your wealth creation is going to come from 2 things. First, how much money you actually invest. And second, how long you stay invested. It's not going to come from picking the right stocks. It's not going to come from timing the market. It's not going to come from any sophisticated strategy. It's going to come from investing consistently month after month, year after year, and letting compound interest do its work. If you invest $1,000 per month for 30 years, you're going to get wealthy. The specific investments you choose matter far less than the discipline to actually keep investing. That's why I recommend ETFs to beginners. ETFs, or exchange-traded funds, are beautiful investments because they're simple, they're low cost, they're diversified, and they require almost no maintenance. You buy them once and you can pretty much forget about them. You don't have to pick individual stocks. You don't have to understand accounting. You don't have to read financial statements. You don't have to time anything. You just buy and hold. In over 30 or 40 years, you accumulate substantial wealth. Let me tell you about the specific 3 ETFs that I would recommend to a beginner, and I want to be very clear. These are not the only ETFs worth owning. There are other good ones out there. But if you had to choose just 3, if you had to keep it simple, these are the 3 I would choose. The first ETF I would recommend is VOO, which stands for Vanguard S&P 500 ETF. This ETF tracks the S&P 500, which is an index of the 500 largest U.S. companies. Apple, Microsoft, Google, Amazon, Tesla, Johnson & Johnson, Procter & Gamble, Coca-Cola, all the best companies in America are in this index. And the beautiful thing about owning an S&P 500 index fund is that you own a piece of every large American company. You get diversification across sectors: technology, healthcare, finance, consumer staples, energy, industrials. All of it is represented. You don't have to pick which companies to own. You own all of them. And over the long term, the S&P 500 has returned approximately 10% per year on average, including dividends. Now, 10% per year might not sound like much, But let me show you what that actually means. If you invest $100,000 today in an S&P 500 index fund and you don't touch it for 30 years and you get 10% per year, which is the historical average, your $100,000 grows to $1.74 million. That's real wealth. That's not accounting for additional contributions. If you invest $1,000 per month into an S&P 500 index fund, that's $12,000 per year, and you get an average of 10% per year. After 30 years, you have accumulated approximately $1.3 million. That's enough to provide a comfortable retirement for most people. The reason I recommend VOO specifically rather than other S&P 500 index funds is because of the expense ratio. The expense ratio is the annual fee that the fund company charges to manage the fund. VOO has an expense ratio of about 4 basis points, which means you pay 4 cents per year for every $100 you have invested in the fund. That's incredibly cheap. You're paying less than 0.1% per year. Compare that to the average actively managed mutual fund that charges 1% or more per year over 30 years. That difference in fees compounds into tens or hundreds of thousands of dollars. So choosing a low-cost index fund like VOO rather than an expensive actively managed fund could literally be worth hundreds of thousands of dollars. This is not a small detail. This is massive. VOO is also highly liquid, meaning you can buy and sell it anytime the market is open, just like a regular stock. It's also available in virtually every brokerage account. You can buy it at Vanguard, at Fidelity, at Schwab, at Robinhood, at any broker. The fund has been around since 2010 and has attracted hundreds of billions of dollars in assets. It's as safe and stable as an investment gets. The second ETF I would recommend is VEA, which stands for Vanguard FTSE Developed Markets Index ETF. This ETF tracks companies in developed markets outside the United States, countries like Canada, the United Kingdom, Europe, Japan, Australia. The fund owns thousands of companies across these developed markets. The principle here is diversification. The United States is wonderful, but it's not the whole world. There are great companies in every developed country. By owning VEA, you get exposure to international companies and international economic growth. Now, I know what you're thinking. Warren, you said you prefer to invest in the United States. You said you love American companies, and that's true. I do, but I also recognize that over long periods of time, diversification across developed markets makes sense. The United States might underperform international markets for a decade or two, or the reverse might be true. You don't know ahead of time which will do better. By owning both, you eliminate the risk of getting it wrong. You capture whatever returns developed markets around the world generate. The International Developed Markets Fund has returned about 7 to 8% per year on average over long periods, which is lower than the S&P 500, but still excellent. And importantly, the correlation with U.S. stocks is imperfect, meaning that when the U.S. market is down, international markets might be flat or up. That provides some diversification benefit. VEA also has a very low expense ratio of about 5 basis points. You're paying 5 cents per year for every $100 invested. That's incredibly cheap. I would recommend that a beginner allocate about 10 to 20% of their portfolio to VEA. The rest would be in VOE. This gives you primarily U.S. exposure with some international diversification. It keeps things simple, it keeps costs low, and it provides reasonable diversification. Now, here's something important. A lot of beginners ask about emerging markets. Should I own ETFs that track emerging markets like China, India, Brazil? And my answer is maybe, but not necessarily. Emerging markets are riskier than developed markets. They're more volatile. They have higher fees. For a beginning investor, I think it's better to stick with developed markets. You get diversification without the extra risk. As you get more sophisticated and your portfolio grows, you could add emerging markets if you wanted to. But to start, developed markets are fine. The third ETF I would recommend is BND, which stands for Vanguard Total Bond Market Index ETF. This ETF tracks the entire U.S. bond market, investment-grade bonds, government bonds, corporate bonds. It's thousands of bonds from thousands of issuers. By owning BND, you own a diversified portfolio of bonds. Now, I know this might surprise you. I spend a lot of time talking about stocks and investing. You might think I recommend that everyone own only stocks, but that's not true. Bonds are important. Bonds provide stability, they provide income, they provide diversification away from stocks. When stocks are down, bonds often hold up or go up. When stocks are up, bonds go sideways. That's not a bug, that's a feature. That's what you want in a diversified portfolio. The question for beginners is how much to allocate to bonds. This depends on your age and your risk tolerance. If you're 25 years old and you're just starting to invest, you might allocate only 10% to bonds and 90% to stocks. Stocks are going to outperform bonds over 30 or 40 years, and you have time to ride out the volatility. If you're 45 years old, you might allocate 30 to 40% to bonds. If you're 60 years old, you might allocate 60% to bonds and 40% to stocks. The younger you are, the more stocks you should own. The older you are, the more bonds you should own. For purposes of this discussion, let me assume you're a 25-year-old beginner with a 30-year time horizon. I would recommend allocating 80% to stocks, which breaks down as 65% to VOO and 15% to VI. Would allocate 20% to bonds through BND. This portfolio is diversified, it's simple, it's low cost, and over 30 years it's going to generate substantial wealth. Now let me walk you through the actual mechanics of how to implement this. First, you need a brokerage account. This is an account through a financial institution that allows you to buy and sell investments. Popular brokers include Vanguard, Fidelity, Schwab, Robinhood, Wealthsimple if you're in Canada. Most of these allow you to open an account online for free. It takes about 15 minutes. Second, you fund your account, you link a bank account and transfer money into your brokerage account. And third, you buy the 3 ETFs, you decide on your allocation. Let's say you have $10,000 and you want a portfolio that's 65% VOO, 15% VAA, and 20% BND. You buy $6,500 of VOO, $1,500 of VAA, and $2,000 of BND. That's it. You've now built a diversified portfolio. Fourth, and this is critical, you set up automatic monthly contributions. This is the key to building wealth. If you can invest $1,000 per month, you set up automatic transfers from your bank account to your brokerage account. Then you set up automatic purchases of the 3 ETFs in the same allocation. Every month, you're buying more VO, more VA, and more BND. This creates dollar cost averaging. You're buying some shares when prices are high and some shares when prices are low. Over time, you average out to a reasonable price. Fifth, you hold. This is the hard part. Markets are going to go down. There will be crashes. There will be recessions. You'll see your portfolio down 10%, 20%, 30%. You'll be tempted to sell. You'll be tempted to switch to something else. Don't hold. The stock market has recovered from every crash in history, every single one. It always goes down. It always comes back up higher than before. If you sell during a crash and miss the recovery, you lock in losses and miss the gains. But if you stay invested and keep buying, you make a fortune. Let me give you some examples of how this works. Let's say you start investing in 2020, right before the pandemic crash. The market is about to decline 40%. You don't know that. You just start buying VOO and VA every month. The first few months, the market crashes, you're down, you're frustrated, but you keep buying. Your $1,000 monthly investment is now buying shares at lower prices. By the end of 2020, the market has recovered and started going up. By the end of 2021, you're up significantly. By the end of 2024, you've invested $48,000, but your portfolio is worth maybe $75,000 or $80,000. You made money not because you picked the right stocks, not because you timed the market, but because you invested consistently and you didn't panic. Now let me talk about taxes, because this matters, especially if you're in Canada or the UK where tax treatment is different. In the United States, if you're investing in a regular taxable brokerage account, you pay capital gains taxes when you sell at a profit, and you pay income taxes on dividends. ETFs are fairly tax efficient compared to mutual funds, but you still have tax consequences. However, if you're using a tax-advantaged account like a 401k in the United States, an RRSP in Canada, or an ISA in the UK, you can avoid or defer these taxes. I would strongly recommend using tax-advantaged accounts as much as possible. In the United States, you can contribute $6,500 per year to a Roth IRA or traditional IRA. You can also contribute up to $23,000 per year to a 401k if your employer offers one. In Canada, you can contribute to an RRSP or a TFSA. In the UK, you can use an ISA. These accounts provide significant tax advantages that let your investments compound without being taxed every year, over 30 years. That can make an enormous difference in how much wealth you accumulate. My recommendation is to max out your tax-advantaged accounts first. If you can contribute to a 401k, do it. If you can contribute to an IRA, do it. If you can contribute to an RRSP or TFSA, do it. Once you've maxed out those accounts, then invest in a regular taxable brokerage account. This strategy maximizes your wealth accumulation. Now let me talk about something that I think is really important, the psychology of investing. A lot of beginners get discouraged because they don't see results immediately. They invest for a few months and the market goes down. They think they're doing something wrong. They think they should switch strategies. They think they should try something else. None of that is true. Investing is boring. It's supposed to be boring. You're building wealth over decades, not months. The first few $1,000s you invest might only grow to $10,000 or $15,000 over 5 years. That doesn't feel like much, but after 20 years, you have a couple $100,000. After 30 years, you have over $1 million. That's how it works. Slow at first, then exponential at the end. I also want to address the fear of missing out, or FOMO. You're going to see headlines about stocks that have gone up 500%. You're going to see social media posts from people who made money on crypto or options or penny stocks. You're going to be tempted to try it. Don't. That's how people lose money. That's how people give back all their gains. The people who got rich investing in stocks didn't do it by chasing hot stocks or trying to get rich quick. They did it by boring, consistent investing in diversified index funds every single time. So ignore the noise. Ignore the headlines. Ignore the people bragging about their hot stock picks. Just buy your 3 ETFs every month. You'll end up wealthier than most of them. Let me also talk about rebalancing. If you start with a 65, 15, 20 allocation of VOO, VEA, and BND, and the stock market goes up 50% while bonds go down, suddenly your allocation might be 75, 20, 5. Your portfolio has drifted from your original allocation. You should rebalance once per year. You sell some of the outperforming assets and buy some of the underperforming assets to get back to your target allocation. This forces you to sell high and buy low, which is the exact opposite of what most investors do. This discipline adds 1 to 2% per year to your returns over time. Now let me talk about something that I think is critical for beginners, understanding that this strategy works over the long term. I'm talking about 20 to 30 years minimum. If you're going to invest for only 5 or 10 years, the stock market might be down. You might lose money. But if you have a 20 or 30-year horizon, the stock market has never lost money over any 20-year period in history. Never. So this strategy only works if you commit to holding for decades. If you think you might need this money in 5 years, don't invest it in stocks. Keep it in cash or bonds. But if you're investing for a house down payment that you need in 2 years, don't put it in an index fund. Use a regular savings account. Index funds are for long-term wealth building. That's their purpose. Let me also address something about young people. I think young people have an enormous advantage in investing that they don't realize. Time, if you're 25 years old and you invest $1,000 per month in an S&P 500 index fund, by the time you're 65, you have about $3.8 million. If you wait until you're 35 to start investing the same $1,000 per month, you end up with about $1.3 million. That extra 10 years of starting early resulted in nearly $3 million more. That's the power of compound interest. Start early. The earlier you start, the richer you'll be. I can't overstate this. Let me also talk about market crashes and recessions. I want to normalize the idea that markets crash. Markets have crashes and recessions all the time. Sometimes they're small, like 10% declines. Sometimes they're big, like 50% declines on average. The stock market declines at least 20% every few years. That's normal. That's not a failure of the system. That's how markets work. If you know going in that your portfolio is going to decline 20, 30, 50% at some point, it doesn't freak you out when it happens. You expect it, you plan for it, you have cash available. You keep investing, you don't panic. Here's a specific example. Let's say you're investing $1,000 per month in an S&P 500 index fund. The market crashes 40%. Your portfolio is down 40%. But you've been investing for 5 years, so you have $60,000 invested. A 40% decline means you've lost $24,000 in value. Your portfolio is now worth $36,000. That's scary. That's real money. But here's what you do. You don't sell, you keep buying. In fact, you might even increase your contributions if you have extra money, because stocks are on sale. In 5 years, when the market has recovered and gone up 50% from the crash, your portfolio is worth much more than it would have been if you'd sold. The people who bought during the crash made the most money. I want to tell you a story about a friend of mine. He started investing in 2007, right before the great financial crisis. The market crashed 50% over the next year. His portfolio went from $30,000 to $15,000. He was devastated, but he kept buying. In fact, he increased his contributions. He was buying stocks while they were cheap. By 2009, the market started recovering. By 2019, his portfolio was worth millions of dollars. If he'd sold in 2008 like most people did, he'd have nothing. But because he stayed the course, he built enormous wealth. Now let me talk about expenses. This is so important. The 3 ETFs I've recommended have incredibly low expense ratios. VU charges about 4 basis points per year. VEA charges about 5 basis points. BND charges about 3 basis points. That's basically free. You're paying almost nothing to own these funds. Compare that to the average actively managed mutual fund that charges 1% per year or more, or the average financial advisor who charges 1% per year to manage your money, or robo-advisors who charge 20 to 40 basis points, or financial advisors who charge 2% or more. Those fees add up over 30 years. A 1% annual fee costs you about 40% of your portfolio. You're leaving your money on the table. This is why I'm so passionate about low-cost index funds. It's not just about academic theory, it's about real money. It's about hundreds of thousands of dollars that end up in your pocket instead of in fund companies. And advisors' pockets choose low-cost funds. It's one of the few things you can control as an investor. You can't control market returns, you can't control when crashes happen, but you can control fees. So minimize them. Let me also talk about dividend reinvestment. The ETFs I've recommended pay dividends. VOO pays about 1.5% to 2% in dividends. VEA pays about 3 to 4%. BND pays about 4 to 5%. These dividends are paid quarterly. You have a choice. You can receive the dividends as cash, or you can have them automatically reinvested to buy more shares of the ETF. I recommend automatic reinvestment. This way your dividends are compounding. You're buying more shares with your dividends. Those shares generate dividends. Those dividends buy more shares. Over decades, this compounding effect is massive. Now let me talk about monitoring your portfolio. How often should you check it? My recommendation is not very often. Check it maybe once per quarter when you make your monthly contributions. Make sure the transfers went through. Make sure the purchases went through. That's it. Don't check it every day. Don't check it every week. Seeing daily fluctuations will drive you crazy. You'll be tempted to make changes. Resist the temptation. The best portfolio is one you don't think about. The best investor is one who buys and holds and doesn't obsess over daily prices. Let me also talk about something about behavioral finance. Most investors underperform the market because of their own behavior. They buy high when everyone is excited and prices are expensive. They sell low when everyone is panicked and prices are cheap. They chase performance. They follow the crowd. They make emotional decisions. If you use the system I've outlined, you eliminate most of these behavioral errors. You're buying automatically every month, regardless of how you feel. You're not picking stocks. You're not timing the market. You're not chasing performance. You're just investing consistently. This mechanical approach actually outperforms most active investors who think they're being clever. Now, let me talk about something specific for each of the 3 ETFs I'm recommending. Let me tell you what these funds own and why I've chosen them. VU, the S&P 500 Index Fund, owns the 500 largest U.S. companies. As of now, the top 10 holdings are Microsoft, Apple, NVIDIA, Alphabet, Amazon, Tesla, Berkshire Hathaway, Eli Lilly, Magnificent Seven companies, and others. These are extraordinary companies. These are companies that have dominated their industries for years or decades. By owning the entire S&P 500, you own a piece of all these companies, plus 490 other large companies. You're getting diversification across all sectors and all sizes of large companies. VIA, the Developed Markets Index Fund, owns companies in developed markets outside the U.S. countries like Japan, Switzerland, Germany, France, Canada, Australia. The fund owns thousands of companies. You get exposure to different economies, different currencies, different industries. When the U.S. dollar is weak, companies in other countries benefit. When the U.S. dollar is strong, U.S. companies benefit by owning both. You're not betting that either currency will outperform. B&D, the Bond Index Fund, owns thousands of bonds across the entire U.S. bond market: government bonds, corporate bonds, mortgage-backed bonds, short-term bonds, medium-term bonds, long-term bonds. Investment-grade bonds, which are safe, are heavily weighted. The fund provides income and stability. When stocks decline, bonds often hold up or go up because investors seek safety. This provides a cushion to your portfolio during stock market downturns. I also want to talk about rebalancing between the 3 funds. Let's say you have an allocation of 65% VOO, 15% VAA, and 20% BND over a year. If stocks go up a lot and bonds go down, your allocation might drift to 70% VOO, 12% VEA, and 18% BND. You should rebalance once per year by selling some of the outperforming assets and buying some of the underperforming assets. This forces you to sell high and buy low. It's one of the few things you can actively do that mathematically improves your returns without taking additional risk. Let me now talk about something that's specific to different life stages. If you're 25, I would recommend 90% stocks, 10% bonds. That might be 85% VU, 5% VEA, and 10% BND. If you're 35, I would recommend 80% stocks, 20% bonds. That might be 65% VOO, 15% VEA, and 20% BND. If you're 45, I would recommend 70% stocks, 30% bonds. That might be 55% VO, 15% VA, and 30% BND. If you're 55, I would recommend 60% stocks, 40% bonds. As you get older, you gradually shift toward more bonds. This is called a life cycle or age-based allocation. Now let me address a common question. Should I include international bonds? Should I include emerging markets? Should I include real estate? My answer for beginners is no. Keep it simple. The 3 funds I've recommended provide all the diversification most beginners need. As you get more sophisticated, you can add other investments. But to start, keep it simple with these 3 ETFs. Simplicity itself is valuable because you'll actually stick with the system. If it's too complicated, you'll abandon it when the market gets rough. Let me talk about something else that's important: the power of continuing to invest during market downturns. Most people stop investing when the market crashes. They're scared. They want to see if things recover. They want to conserve cash. But this is exactly backwards. Market crashes are the best time to invest. You're buying at the lowest prices. You're investing the same dollar amount, but getting more shares. Over the long term, this is incredibly valuable. Let me give you math on this. Let's say you invest $1,000 per month. In normal times, the S&P 500 is at a price of $400. You're buying 2.5 shares per month. Over a year, you buy 30 shares. Then the market crashes and the price of the S&P 500 drops to $200. You're now buying 5 shares per month. Over a year of the crash, you buy 60 shares. When the market recovers and the price goes back to $400, those 60 shares you bought during the crash are now worth $24,000. But you only spent $12,000 on them. You've doubled your money on the shares you bought during the crash. Meanwhile, the 30 shares you bought before the crash are still worth $12,000. The crash was an opportunity, not a disaster. This is why continuing to invest during crashes is so valuable. This is why you need to have the discipline to keep buying even when it's scary. Most investors don't have this discipline. Most investors sell during crashes. But if you have the discipline to keep buying, you'll outperform almost everyone. Now let me talk about something practical. How do you actually get started? First, open a brokerage account with Vanguard, Fidelity, Schwab, or another reputable broker. It takes 15 minutes. Second, verify your identity and fund your account. You link a bank account and transfer money. Third, purchase your initial allocation of the 3 ETFs. If you have $10,000, buy $6,500 of VOO, $1,500 of VA, and $2,000 of BND. Fourth, set up automatic monthly contributions. If you can save $1,000 per month, set up an automatic transfer from your bank to your brokerage account. Fifth, set up automatic purchases of the 3 ETFs every month. Automatically buy the 3 ETFs in your desired allocation. Sixth, enable automatic dividend reinvestment in each fund. This way, dividends automatically buy more shares. Seventh, rebalance once per year by selling overweight positions and buying underweight positions. Eighth, hold for decades. Don't check it constantly. Don't panic during crashes. Just hold. Let me address one more common question. Aren't index funds getting too expensive? Isn't the S&P 500 at an all-time high? Isn't this a bad time to invest? My answer is no. First, yes, the S&P 500 is at an all-time high, but it's always at an all-time high eventually because companies earn money and grow over time. That's normal. Second, the valuation is not unreasonable by historical standards. The PE ratio is around 20 times earnings. That's not crazy. Third, and most importantly, you're investing for decades. You're not investing for this year or next year. You're investing for the next 30 years. And over 30-year periods, the stock market has always gone up. Even if you buy at the peak before a crash, if you hold for 30 years, you make money. So there's no such thing as a bad time to start investing if you have a 30-year time horizon. There's only not starting. Let me tell you about one final thing, the importance of having an investment plan and sticking to it. A lot of beginners don't have a plan. They just throw money at whatever is hot. They chase returns, they switch strategies, they make emotional decisions, all of this underperformance. But if you have a plan, if you commit to investing in these 3 ETFs every single month for 30 years, if you rebalance once per year, if you ignore the noise, you will do well. You will build substantial wealth. That's not luck, that's not complicated, that's just discipline and staying the course. Here's what I want you to do right now if you're a beginner. First, commit to starting to invest today. Not next month, not next year. Today, open a brokerage account, fund it with whatever money you can afford. Second, buy the 3 ETFs, 65% VOO, 15% VA, 20% BND, or adjust the allocation based on your age and risk tolerance. Third, set up automatic monthly contributions and automatic purchases. If you can invest $1,000 per month, that's fantastic. If you can only invest $100 per month, that's also fantastic. Any amount is better than zero. Fourth, commit to holding for 30 years minimum. Don't check it constantly. Don't sell during crashes. Just hold. Fifth, rebalance once per year. And that's it. That's the entire system. If you do this, if you follow this system, I absolutely guarantee you that in 30 years, you will have built substantial wealth. Not because I'm magic, not because I'm predicting the future, but because the math works. Compound interest is powerful. Stock market returns are powerful. The power of not panicking is powerful. If you combine all three, you get rich. I've been investing for over 70 years. I've seen market crashes. I've seen recessions. I've seen inflation, I've seen deflation, I've seen everything. And through it all, the people who got wealthy were the ones who invested consistently in diversified index funds and held for decades. That's the pattern. That's the formula. It works. It will always work. So start today. Open your account, buy your 3 ETFs, commit to holding for 30 years, and build wealth. If this content has been valuable to you, if you now understand why 3 ETFs are all a beginner needs to build long-term wealth, I need you to do something for me. Like this video, hit that thumbs up button. Let me know you found value in this content, and subscribe to this channel right now, because I'm going to keep bringing you content about index investing, about building wealth, about how to get rich slow by staying boring and disciplined. New videos every single week. Don't miss a single one. Turn on notifications so you're alerted the moment I post a new video. Leave a comment below. Tell me your age. Tell me how much you're planning to invest per month. Tell me which of these 3 ETFs excites you most. Tell me if you're going to start investing today. I read every comment and I respond to as many as I can. This is a community and I want to hear from you. The path to wealth for most people is not exciting. It's not glamorous. It's not featured on the news. It's boring. It's consistent. It's 3 index funds held for decades, but it works. It works for everyone. You don't need to be a genius. You don't need to know anything about the stock market. You just need discipline. You just need to invest every month. You just need to hold, do that, and you become wealthy. It's that simple. Thank you for watching. I'll see you in the next video.